Okay, in this video, uh, I'm going to explain you some activities available in your textbook, that is grade 10 syllabus. If you come to page number 75 in your grade 10 textbook, we are given uh, three activities regarding double entry principles and another activity for you to understand cash book and other things. I want to discuss activity number 2 and 3 for you to understand double entry principles and ledger accounts. Please prepare your grade 10 business and accounting studies textbook, page number 75, because now I am going to uh, explain the question by using the whiteboard. If I use screen share, then my answer won't be clear for you. Therefore, please refer your textbooks with my answer. Right. When it comes to activity number 2, following transactions that occurred in a business during the month of March 2020, write a double entry of each transaction. Right. Even though they have asked you to write double entry, I will write double entry and prepare ledger accounts also. That means both double entry and ledger accounts. Right. Transaction number 1, introduction of capital by the owner, 200,000 rupees. When the owner introduced capital to the business, we have to debit to cash account 200,000 and we have to credit to capital account another 200,000. When the owner introduces money to the business as his or her capital, we have debit to cash account 200,000 rupees and credit to capital account 200,000 rupees. That is the answer for transaction number 1. Transaction number 2, cash purchases rupees 50,000. When they purchase goods in cash, they are decreasing cash assets, therefore we have to credit to cash account. The concept is decrease assets credit and purchases account debit. The reason is when you purchase goods, your expenses will increase. Therefore, expenses increase debit. Then we have to debit to purchases account. Purchases account, DR, 50,000 rupees. And as they have purchased in cash account, CR, 50,000 rupees. That is the answer for transaction number 2. Then transaction number 3, paid the monthly rental 10,000 rupees. Rental is expense. Increase in expense debit. That is the principal for expenses. And we have to credit to cash 10,000 rupees. Reason, when you pay rental, there will be decrease in asset. Asset decrease credit. Then rent expenses, DR, 10,000 rupees. Cash account, CR, 10,000 rupees. That is the answer for transaction number 3. Then we can take transaction number 4. Cash is 7,000 rupees. Cash is 7,000 rupees. When you receive money for cash, cash asset increases. Therefore, we have to debit to cash account. We are 7,000 rupees, and we have to credit to sales account 70,000 rupees. The reason is sales come under income. Income increases credit. So income, sales income, CR 7,000 rupees. Then transaction number 5, purchase goods on credit 8,000 rupees. When we purchase goods either on credit, so in cash, purchases increases. Purchases comes under expenses. Therefore, expenses increases debit. Then again we have to debit to purchases account. Purchases account 8,000. Then here they have purchased goods on credit base. That means at the time of purchasing, the business doesn't need to pay money to the supplier. The business will pay it later, the due amount. Therefore, the business will pay another liability called creditors, those supplies, accounts payable. It comes under liability. Liability increases credit. So we have to credit to creditors account. Yeah. 80,000. Right. That is the answer for transaction number 5. Then transaction number 6, withdrew money by the owner for personal use 10,000 rupees. You know, owner cannot take business money or goods for their personal use. If they take business money or goods, it is called drawings. Drawings will affect reduced capital. Therefore, double entry principle is capital debit. If they have taken money, we have to credit to cash as it decreases. If they have taken goods, we have to credit to purchases because expenses decreases. But here, as a tradition, as a principle, we don't debit to capital. Instead of that, we maintain a separate account called drawings. Then, if there is an increase in drawings, we debit to drawings account. Then, we maintain separate account called drawings account DR 10,000 rupees. As they have taken money, we have to credit to cash account because cash assets decreases. Asset decrease credit, therefore we credit to cash account. Cash account credit 10,000 rupees. Right. That is the answer for transaction number 6. Then we can move to transaction 7, 8, 9. If you really understand double entry principle, it is easy going to record business transaction in ledger accounts. Then transaction number 7, paid monthly salaries 20,000 rupees. Salaries comes under expenses. Business has to pay salaries to the employees, those who are working in the business. That is an expense for the business. Therefore, expenses increases debit. Then we have to debit to salaries account 10,000, and as they have paid money, cash asset decreases. Asset decreases credit, therefore we have credit to cash account. Cash account credit 20,000. That is the answer for transaction number 7. Transaction number 8, obtain a bank loan 200,000 rupees. When you take a bank loan from a bank or from any other financial institution, you receive money to the business. Then cash asset increases. Asset increases, therefore, you can debit to cash. Cash account debit 200,000. And when a business takes a bank loan, then it comes under liability. Then they create another liability called bank loan account. Liability increases credit. So we maintain separate account called bank loan account and credit to that account 200,000 rupees. But I would like to say practically, if a business asks a bank loan from a bank or from any other finance institution, they normally ask the business to open bank account. And when the bank loan is approved, what the bank does is, bank normally transfer funds to that bank account. Therefore, here I mentioned cash account, but practically, we normally debit to bank account. If the business has taken a bank loan, bank account debit, bank loan account credit. Because they don't give money in cash, they normally ask the business to open bank account and it transfers funds to that account. Right. Transaction number, that is number 8. Then number 9, invested in a fixed deposit account, 10,000. Now business has money, additional money. Therefore, they have invested 10,000 in a fixed deposit account. In a business, we can have 3 types of accounts: normal savings account, fixed deposit account, and current account. Here they have opened a fixed deposit account. Then they have used business money. Therefore, there will be decrease in cash assets. Then asset decrease, credit. Therefore, you have credit to cash account. And as they have opened fixed deposit account, it comes under asset. It's an asset for the business. Therefore, asset increases, debit. So we can debit to fixed deposit account. Account DR 10,000 rupees. And as money goes out of the business, asset decreases, cash asset decreases. So we can credit to cash account another 10,000 rupees. Right. So that is the answer for transaction number 9. Then, if we take transaction number 10, credit sales 60,000. When the business sells goods or provides a service on credit, the business doesn't receive money at the time of selling. The people who purchase goods from the business will pay later. They are due. Either of that, they create another asset called debtors, so accounts receivable. So credit sales 6,000. Then business will create an asset called debtors or accounts receivable. Then it comes under asset. Asset increases, debit. So debtors account, DRY, asset increases because debtors comes under asset 60,000 rupees. And sales is the main income source of the business. Sales come under income. Income increases credit. So we can credit to sales income account 60,000. Right. 60,000. As debtors asset increases, we debit to debtors account 6,000. As sales income increases, we credit to sales income account 60,000 rupees. So that is the answer for the given question in the Yes, look, they have asked you to write double entries, but I would like to record those transactions in your ledger also. Then we understood double entry principle. It says that any business transaction has two bits called debit and credit. Therefore, at the same time, we have debit to one account and we have credit to another account the same amount. Therefore, depending on our ledger accounts available in business ledger, we have created five principles. Principle for assets increases debit, decreases credit. Principle for expenses increases debit, decreases credit. Therefore, expenses and assets have got the same principle, increases debit, decreases credit. Then income, capital and liability, those three accounts have got the same principle, increases credit, decreases debit. Income, capital, liability, increases credit, decreases debit. So we can apply those five principles to solve this question. Introduce capital by the owner 200,000. Then we can have cash account. Then we can write a date, March 1st, capital 200,000. And we can have another account, capital. Then say March 1st, cash 200,000. Right. Cash account debit because asset increases, and capital account you have credited because capital increases credit. The second transaction, cash purchases 50,000 rupees. Then we can have another expense account, that is purchases. Purchases comes on the expense. Then expenses increase debit. Then 50,000 rupees you can debit to that account. Say 2nd March cash. And you can credit to cash account, say purchases 50,000. Third transaction, paid the monthly rental 10,000. Then you can have another account that is also expense rent. Then rent expense increase debit, therefore you can debit to this account 10,000. It happened 3rd March, say cash. Then you can credit to cash account, say rent 10,000. Then 4th transaction, cash says 70,000. Then you receive money, therefore you can debit to cash account, say sales. It happened 4th March. And you can have another account. It comes on income. Then you can credit, say in cash, 70,000. Next transaction, purchase goods on credit 80,000. Purchase goods on credit, purchases increases. Then we can debit to purchase accounts. Say in creditors. It happened 5th March. As they have purchased on credit, we don't pay, therefore we can't pay to cash. We have to open another account, that is creditors. That is liability. Then you can take with March purchases 8,000. Purchases 80,000. I will draw the account again. Creditors account. Here, creditors 80,000. If March purchases, liability increases. This is a liability account. Right. At the beginning, it is helpful for you to understand the type of account. Next one, withdrew money by the owner for personal use 10,000. If the owner has taken money from the business, then we give it to another account called drawings. Then we can debit 10,000. That account saying the date 6 March cash. As cash decreases, we can credit to cash account saying drawings 10,000. 7th May, 7th March, paid monthly salaries 20,000. Salaries also comes under expenses. Expenses increases debit, so we can debit 7th March, say in cash. Then we pay salaries in cash, therefore cash asset decreases, then we can credit to 20,000 to cash account. Next one, 8th March, obtain a bank loan. When you take a bank loan, your cash asset increases by 200,000. It happened 8th March, bank loan. And you can open another account that is also liability and credit 8th March cash 200,000. I told you practically, if you ask a bank loan from bank, they will ask you to open new bank account and they will transfer funds to the bank account. But here we take it to cash. And 9th March, invested in fixed deposit 10,000. Then we can have fixed deposit account, that is asset. Therefore, we debit 10,000, say 9th March cash, and we can credit 9th March 10,000. Then last transaction, credit shares 60,000. When you take sales, we don't receive money because credit sales, we create another asset called debtors. So we can have another asset called debtors and debit. Asset and debit 60,000. 10th March sales. And we can credit sales account 10th March saying debtors another 60,000 rupees. Right. That is the end of item number 2. Then we can move to item number 3. Later on, I will teach you how to balance these ledger accounts. We'll be having another chapter to understand how to balance these ledger accounts. Then if you take item number 3, they have asked you to record the given transaction in ledger accounts. So for you to understand, I will write double entries also, even for this exercise. So item number 3, it is in page number 76. You refer your textbook. Page number 76, item number 3. Following are some transactions occurred in Nimal's business. Then January 1st, introduced capital 300,000. Then you can write double entry, debit to cash and credit to capital account. Cash asset increases, therefore, cash account DR 300,000, and as capital increases, we credit to capital account 300. Then number 2, purchase equipment for use in the business 50,000. Equipment comes under non-current assets. Therefore, asset increases, debit so we debit to equipment account 50,000, and as they are purchasing cash, money goes out as a decreases credit, then you credit to cash account 50,000. Right. Number 3, purchase goods on credit 8,000. When you purchase goods, the expenses will increase, then purchases account debit 8,000. As the business doesn't pay money at the time of purchasing, they paid another liability called creditors. Therefore, we credit to creditors account 80,000. Right. In transaction number 4, pay telephone bill of the owner's house using cash of the business 5,000. Any owner cannot pay their personal expenses by using business money. If they have used business money, it will happen to reduce their capital. Then it is called drawings. Drawing increases debit. Then we open separate account drawings and DR 5,000. And as they have used business money, money goes out. Money decreases, asset decreases credit. Therefore, cash account debit 5,000 rupees. Number 5, cash is 5,000. When you take cash as money receives, the business receives money from cash, then cash asset increases, cash account DR 50,000. As sales come under income, then income increases credit, then sales account CR 50,000. Right. Next one, now transaction number 6, paid insurance 70,000. Paid insurance 70,000. Then insurance comes under expenses. So expenses increases debit Then you can debit to insurance account. Number 6, insurance account DR 7,000 as they have paid in cash. Cash asset decreases, so cash account credit 7,000. Transaction number 7, paid cash purchases 40,000. Cash purchases 40,000. Then purchases come under expenses. Expenses increases debit. So purchases account DR 40,000. As they have paid money, then cash asset decreases, so cash account CR 40,000. Transaction number 8, paid creditors 20,000. When you pay money, it will affect to decrease cash assets, therefore cash account credit. And when you settle liability, that is creditors, liability decreases, therefore liability debit. Then creditors account DR by 20,000. As they pay in cash, money goes up, therefore cash decreases, cash account CR 20,000. The other double entries related to active number 3 available in your page number 76. Now we can prepare ledger accounts regarding these transactions. Now we can prepare ledger accounts regarding these transactions. Transaction number 1 introduces capital, then we can have cash account, that is asset, and we can have capital account. Right. 1st January, capital 300,000. Then 1st January, cash 300,000 capital. Always when you write a description, you write opposite account's name in the description column in any type of accounts. Number 2, purchase equipment for use in the business. So we can arrange another account. Equipment, asset, and debit 50,000. Sale 2nd January, cash. Then you can credit to cash account 2nd January. Equipment 50,000. Right. Then 3rd transaction, purchase goods on credit 80,000. You can have purchases account, expenses, and debit 8,000. It happened 3rd January, same regulars. Then you can have another account, creditors. That is liability and credit 3rd January. Purchases 80,000. Next, pay telephone bill of owners using business money. Then you can have drawings account and debit 5,000. It happened 4th January. Cash and you debit same drawings, credit to capital, a cash account 1,000. Then cash sales 50,000. Then you receive money 50,000. So sales it happened 5th January. And you can have a separate account for sales and credit to sales account, say cash 1,000. Next, 6th January paid insurance, then insurance comes under expenses and debit 7,000, saying 6th January cash. Then 6th January you credit in your cash account 7,000, say insurance. Then cash purchases 40,000. Then again you can debit to cash account. Sorry, purchases account 40,000, date 7th January, as they have purchases in cash, so in cash. Then 7th January, cash account credit, same purchases, cash account credit, same purchases 40,000. Last transaction paid creditors 20,000. Then you can debit 20,000 to creditors 8th January, say in cash. Then you can credit same creditors to cash account 20,000. Likewise, you can record any business transaction in ledger accounts depending on double principles. That is the answer for activity number 3. Then please refer this answer with your activity available in page number 76 of grade 10 English medium syllabus textbook. Right. Then there will be separate lesson for balancing of ledger accounts. Then I will explain how to balance ledger accounts. If there is any difficulty in preparing these ledger accounts, please inform me by sending a comments section.